Good afternoon, everyone. We're going to talk about money, and we're going to talk about new money because money is changing, and when money changes, it changes everything. Now, about 2 months ago, I got a recommendation from a friend of mine. He's a very even-keeled, he doesn't get excited much. Here he was, buzzing at the seams to tell me about this amazing new bank. And I couldn't believe him. You'd have to see the rest of the conversation for me just being utterly incredulous. What do you mean, bank? Banks are not interesting. Banks are where you keep money, you withdraw money, you get a credit card, you have a mortgage. That's about it. He said, look, just don't believe me, just download the app. I was like, app? Okay, that right there, that's different. And he seemed very insistent. He kept on saying, look, you just have to try it. So I did. I downloaded the app. And after about 2 minutes of onboarding, which is basically to get the 100 points of ID that I needed to open up the account, I was finished. And this is my legit reaction. I apologize for the swear. Because as I finished up, I got two things. I got a pay ID that I could use to receive transfers. We'll come back to that. The other thing I got was a digital debit card issued immediately right into my iPhone, all set up for Apple Pay. And it was connected to the account I had just created. And I transferred $50 into that account immediately using my pay ID from my regular bank account. And then I went out to my cafe and I touched my mobile to the FPOS terminal, and it all just worked. Now, I had been waiting 3 years for my bank to adopt Apple Pay, and it did a few months ago. But I had this debit card, and I had it issued in seconds, and I had it immediately usable, and I had it wired into my savings account. It was pretty neat, and I could see exactly what my friend had gotten so excited about. What happened next is the thing that I hadn't expected. Over the next week, I didn't use cash. Nowhere. And at beginning, I didn't notice. And then it was 2 days and 3 days. And everywhere I went, I just touched my mobile to the FPOS terminal. I paid digitally. I paid for everything digitally. My one inconvenience is I had to keep on topping up this account from my main bank account because I kept spending it down because I was paying for everything using my digital payments. At the end of that first week, I was amazed at myself. I had never really thought that my own transition to digital payments would be so quick and so complete. It was a binary. It was 0 to 1. From none to everything. Now, I shouldn't have been entirely surprised by that because I've been using an iPhone. This is me last week trying to pretend I'm Steve Jobs, by the way. I have been using an iPhone since the day they were launched in 2008 here in Australia. I carry my iPhone pretty much everywhere. I'm sure that is equally true for all of you, whether you have an iPhone or an Android device. And yet, and this is the curious thing, for almost all of that time, my iPhone has lived in a world apart from commerce and economics and finance and payments and that entire human realm that is so much part of our existence. Now, it is true that you have been able to buy things through apps on your smartphone for some time if you give the app your credit card data. It's a bit of a pain. You do it once for like Uber and for PayPal and for Airbnb and so on. There are a lot of apps that have capacities to bill us via our credit cards. And that has made commerce on our smartphones possible of a sort. Fully digital payments actually take that all of the rest of the way. Let me unroll what happens when I bring my mobile close to an FPOS terminal. So the FPOS terminal squirts out a near-field communication request. The request gets answered by my mobile. My mobile, because I have a modern iPhone, scans my face looking for an authorization, and then it squirts that authorization back to the FPOS terminal, which then sends that request along with the amount off to a credit card processor, which then sends it along to my bank, which then checks my account to see if I can actually be authorized for this transfer. and then it sends back an authorization or a decline. And it sends that back to the credit card processor, which then sends it back to the FPOS terminal. And with luck, I have just paid for my soy flat white. All of that needs to happen within just a few seconds. Generally, no more than 5 seconds, because people can't wait. When you make people wait, for what seems to them no good reason, they get angry. Happy customers turn into sad customers. But we have systems in place here. We have systems that can fulfill each of these requests in turn in milliseconds, systems connected to systems, connected to systems. And as long as all of those systems are working as designed, all of this feels absolutely seamless to us. But there are some big assumptions built into the way we handle our digital payments here in Australia. The first of these is that Australians all have credit cards, or perhaps a debit card, which is disguised as a credit card, connected to a bank account. Now, that is not really a big ask here in Australia. The overwhelming majority of Australians have bank accounts. Most of them would have a credit or debit card connected to that bank account. We've made that very easy here. People use their cards or their digital equivalents. Merchants are all set up to receive credit and debit card payments. So it all just works here. But there's a world beyond Australia where it doesn't work like this. It only took a decade for the smartphone in reach and influence to become the most important tool in the entire history of our species. 12 years since Steve Jobs walked onto a stage and said one more thing, and today the majority of human beings are using smartphones. The majority. So yeah, that's mostly everyone in Australia, in America, in Canada, and in the EU. But that's also China and India and Africa, places that aren't wealthy. Places where not everyone has a bank account. Places where almost no one has a credit card. Because even if they did, where would they use it? Would someone pop into their neighborhood corner store in, say, Lagos or Calcutta or Chengdu and buy some laundry powder and pay for that with a credit card? Even if they had a credit card, would the merchant that they were visiting have any way to accept that credit card? It's very unlikely. And yet, with certainty, we can know that the owner of that shop has a smartphone. And it's more than likely that the majority of the customers also have smartphones. And we can make digital payments with smartphones here in Australia. But those folks over there, they can't. They want to trade. They will trade. But they can't use the tool that they're all carrying around with them for trading. And this is where we see the gap. It is a gap between the 700 million of us who have credit cards and the half of us who use smartphones. That is a gap more than 3 billion people wide. And there have been attempts to bridge that gap. Some of those attempts have been wildly successful. The first of them came out of Kenya 12 years ago. A project called M-Pesa, sponsored by Vodafone. It turned tens of thousands of mobile minutes vendors, so you could go and buy minutes for your mobile phone, vendors all across Kenya. It turned every one of them into a banker. Any Kenyan can go to a vendor, give that vendor money, and that money is deposited in their M-Pesa account. And then they can send that money to any other Kenyan via a text message. And that person can go to another mobile minutes vendor anywhere in Kenya and get that money. And these are Kenyans who don't have bank accounts. These are Kenyans who don't have credit cards. M-Pesa doesn't need any of that. You don't even need a smartphone. You just need a basic feature phone because you're just sending a text message. And the whole thing proved so successful 60% of the money volume in the Kenyan economy is now passing through M-Pesa. Startups built merchant services on top of M-Pesa, using the transaction stream to feed analytics engines that could pre-qualify businesses for lines of credit at 100th the cost of before M-Pesa. It's transformed the economy of Kenya. And in China, another place where credit cards are rare, Alipay and WePay allow for direct merchant payments from one smartphone to another. You scan a QR code at the merchant, the funds then move from your account to the merchant account. 700 million Chinese use smartphones. So Alipay and WePay work very well in China, but they do still require bank accounts. And that's not a given. It's not a given in China, it's not a given in Africa, it's not a given in most of the developing world. And the global gap in digital payments needs to be filled with tools that work as well in a world of unbanked and underbanked as it does in a world with well-banked. Because right now, billions of people want to trade using their smartphones, but they can't. When they can, that transition will be as swift and as smooth as my own a few months ago when I got that digital debit card issued into my Apple Wallet and I never looked back. So the need is clear. The gap is obvious. How do we bridge that gap? Well, we're going to need a new form of money. Call it digital currency. Currency rather than a credit or a debit card, because currency is payment itself. It's not just a delicate chain of promises to pay. Currency because it can live in a bank account or in a merchant's point of sale terminal or in a customer's smartphone. We need a form of money that is suited to the way we live, the tools that we use, and the capacities that those tools bring us. Now, would we need a digital currency here today in Australia? You might not think so. We actually have faith in all of our chains of promises to pay one another, and we reckon that does the job. And it does to a point. But those chains also have costs, and those costs are borne by their users. Those costs create friction, minimum charge amounts. And that means there's a whole area of the economy known as microtransactions that can effectively not be serviced by the payment system that we are so rightly proud of. And we'll come eventually in the last part of this talk to what this means for business and the economy. But for now, that we can see even in Australia, even with our digital payment system, we have a gap because the system is so big and these amounts are too small. What we need is a frictionless payment system that can handle transactions of any size. And as it turns out, we actually already have that in Australia. It's called the New Payments Platform, or NPP. How many of you have heard of NPP? Probably most of you. It was mandated by the Reserve Bank to provide instantaneous and essentially zero-cost transactions between financial institutions. And PayID, which can be used to send small payments. It can be used to send payments far too small for the older and more expensive techniques that we normally use, such as FPOS and BPay and credit and debit cards. And I actually had a bit of an experiment with my new bank account on that and sent some very tiny transactions along. PayID has been built on top of the NPP. PayID transactions settle in just a few seconds. They basically have zero cost. Well, NPP Co. won't commit to that. They're a bit vague on how much a transaction cost is. We could possibly today have microtransactions in Australia even without a digital currency. That's a gift. It's one that we haven't seen, even though it's actually right in front of us, because there's a lot of revenue that is already tied up in existing payments systems. And Australia, with its frictionless, very small microtransaction infrastructure, is actually an exception. Now, NPP was built to meet the Reserve Bank's requirements, and it was built by SWIFT. You know them. They're the massive Belgian financial services firm, manage all of the interbank transactions in the world. NPP is a world first. SWIFT wants to be able to take NPP and offer it in every other SWIFT country, every partner country, which is basically the entire world. But it's an expensive bit of kit. Rich countries, sure, they'll take it up, or something a lot like it. Developing nations will make do with what they've got for as long as they can. And once again, we're back to that gap between payments and smartphones. That's why this gap requires digital currency. Now, to be credible, any currency, whether it's physical or digital, has to possess three essential qualities. First, it has to be countable. You have to know how much of it you hold. And although that sounds like a low bar, it's the difference between I own this and I own this much. That's quite important. Second, a currency has to be transferable. I cannot hand you a piece of land, but I can transfer the money equivalent for that land and then in return receive the title to that land. And this transfer is accountable, it's auditable, it's provable. We can know beyond any doubt that this transfer has happened. Finally, someone who holds a countable amount of money cannot transfer that money twice. That means that we cannot counterfeit banknotes or bank coins, at least not with any great ease. It means that we can't play any games with the bank ledger to magic money out of nothing unless we are central bankers. We worked out how to do all of this with coins 2,600 years ago. To do all of this digitally, well, we only just figured that bit out. 11 years ago, in the biggest mic drop in the history of the internet, a pseudonymous author named Satoshi Nakamoto described a new distributed ledger, there's a diagram of it, that provided a complete framework for countable, transferable, and only once spendable digital currencies, Bitcoin. And although it's far from perfect, because first versions rarely are perfect, Bitcoin hasn't been improved on in these three fundamental aspects. Nearly all digital currencies created after Bitcoin generously borrow from the techniques that were pioneered by Satoshi Nakamoto. But Bitcoin is not a very usable digital currency because there's another quality that we want in our currencies. In fact, if not in theory, transfers have to settle quickly. We cannot stand in front of the till at the cafe for 20 minutes waiting for our digital transaction to settle. So digital currency it may be, but Bitcoin is slow, and therefore it is best suited to high value transactions, or as we see today, a store of value, digital gold. Now, the search for an effective digital currency began with Bitcoin. It didn't stop there. Second generation currencies modify one of the design features of Bitcoin, which is that it's radically decentralized, replacing that with a mix of centralized and decentralized systems in order to provide transaction settlement speeds that are needed to make an effective digital currency. And that brings us to the 18th of June, just 4 months ago. An obscure little company, you won't have heard of them. They did their own little internet mic drop, and they changed the world. They published a proposal for a viable global-scale digital currency system designed specifically to enable commerce across the billions of individuals who fall into the gap, those with smartphones, but without easy access to digital payments. And that digital currency, it's known as Libra, is the biggest story in finance in 2019 because the obscure little company behind it was Facebook. Libra is fast. It settles its transactions in a quasi-distributed network of 100 peers, each of whom contribute $10 million in US to create a holding fund of $1 billion that's used to purchase a basket of securities that's used to back the Libra coin. And so unlike Bitcoin, whose value is relative only to itself and its mathematically guaranteed scarcity, Facebook pegs the value of Libra to that basket of currencies, giving it a consistently stable real-world value, a stable coin. And that eliminates the forex risk that's been a big problem for digital currencies because they're mostly highly volatile. Now, to give it gravitas, Facebook, which is the 900-pound gorilla of social networking, brought all of its 900-pound gorilla partners, including Visa and MasterCard and Uber and eBay and Spotify and Vodafone and much more. PayPal was on this list. They dropped out last week because someone finally realized that if this took off, no one will need PayPal. And Libra is more or less ready to go via an organization that's chartered and headquartered in Switzerland. All it needs is some basic regulatory approvals. Oh, but there's the rub. Libra has faced consistent pushback from regulators across the developed world. In the US, EU, India recently passed a law banning all digital currencies that were not made by the Indian central bank. They're illegal to be used in India now. And the central bankers around the world, they're actually worried by Libra. For 100 years, there's been no effective competition for a central bank's control of a money supply. But with Libra, backed by Facebook, which itself is worth nearly $1 trillion, central bankers confront the first digital disruption that they've ever known. And they don't like it one bit. And they want to do everything in their power to give Libra the slow walk so that Libra just dies a lingering death. And that strategy could have worked, but for two things. The first and most important is obvious in the Libra mission statement. Libra is not targeted to the developed world, at least not initially. Libra is for the developing world. And in the developing world, Facebook is the internet. So if you own a corner store in Lagos or Karachi or Quito, that's where Libra will be used. Your customers will pay in Libra, you'll pay your suppliers in Libra, and so on. And suddenly, it won't matter whether you're banked or you're unbanked, because you will have all of the advantages of digital payments via a digital currency. And just as happened to me when I got my digital debit card, developing economies will begin a binary transition away from cash and into digital currencies. And that world, which is 2 billion people who aren't in India and don't have credit cards but do have smartphones, that is Facebook's first target. And if it succeeds there, Facebook will become, for all intents and purposes, central banker to the developing world. That, if I'd said this to you 6 months ago, you would have looked at me like I was mad. But that is now going to happen, and that is quite a thing. Why is Facebook doing this? Well, if we go back all the way to that first distributed ledger that is Bitcoin, we can never forget one thing. It's a ledger. It records every transaction, everywhere, to everyone. All of that sits in the ledger. And while Libra claims to have all sorts of safeguards to preserve the anonymity of transactions, it's well known that Facebook already has the capacity to use multiple interlocking massive data sets to de-anonymize the actions of its users. So an anonymous transaction on Libra is not going to be anonymous to Facebook and probably not anonymous to its partners, which means Facebook will have a massive real-time data set describing the activities of all of Libra's users. And that's really what Facebook is after here. Because when you're the issuer of the digital currency, the benefits of reserve currency status flow to you. And in the digital age, that means an endless stream of valuable transaction data. And it's that gold mine that will keep Facebook moving toward the rollout of Libra in spite of any attempts to slow it down or thwart it or ban it, because the rewards are simply too great. There's a second reason why Libra can't be stopped by central bankers. It's because the central bankers are going to need it. Why? Because 2 months ago today, the People's Bank of China made a short statement in which they acknowledged that Libra had forced them to accelerate their own efforts to release a digital yuan, a fully digital version of the Chinese state currency. And they didn't give an exact date for the release of this currency, but they did indicate that the intention of the People's Bank was to have this digital yuan completely replace coins and banknotes in China. In other words, China is going all in on digital currency. Why? Well, Facebook's Libra is not a threat to China so much as it is an opportunity. The data gathering potential of a digital currency is exactly what the Chinese government wants as it's building its social credit system. Most transactions in China today are not digital. They're not recorded. Within a decade, most transactions in China will be made in digital yuan and will go onto a digital ledger entirely controlled by the People's Bank of China. And here's a sticky bit of foreign policy. You can be sure that the People's Bank of China will be offering their digital currency services to their client states. Hong Kong, Taiwan, Myanmar, Laos, Cambodia, they will all be pressured into using it. And that will provide a huge insight into those economies. Right now, central bankers in the US and the EU, they don't have any alternative to the digital yuan. Libra is all they've got. Facebook said as much in testimony to the US Congress. So it may be that Libra becomes another element in this evolving trade war between the US and China, a way to thwart the data gathering ambitions of the People's Bank of China. And it means that Libra and the digital yuan will both be offered as a gift to developing nations looking for ways to use digital currencies to close the gap between payments and smartphones. And that gap is growing bigger. The pressure to fill that gap is growing as well. So these digital currencies will be offered as a gift to these developing nations. And they'll adopt one or possibly both of them. And that means that the decade ahead will see the global economy tumble headfirst into digital currencies. And there's every chance that this transition will be led by the developing world because they have the greatest need for it. And the transition into a world of digital currencies is going to be quick. It's going to be faster than the adoption of smartphones because digital currencies are already well prepared to leverage the existing base of billions of smartphones. We don't have to wait for people to buy them. It won't be much different than installing an app. And globally, it took a decade to go from 0 to 1 with smartphones. With digital currencies, it's reasonable to expect that this time frame will accelerate again from 10 years to 5 years or possibly less. We have seen already the beginning steps, and we will see the first releases of global digital second-generation currencies over the next 12 months. And this means that the 5 years from 2020 to 2025 are going to be a time of very rapid adoption, rapid change, and rapid growth. Facebook already has an app. It's called Calibra. They have been testing that app privately. They will integrate Calibra's features into Messenger, into Instagram, into WhatsApp, into the Facebook app. They have nearly 2 billion monthly users. Suddenly, those users will be able to trade with one another directly and at zero cost. Now, it's easy enough for someone in America or in Australia to use Facebook Marketplace because we can use digital payments via our credit cards. But Libra integration means that it's going to be easy for someone in Jakarta or Kigali or Sao Paulo, someone who has never had digital payment systems, to trade digitally on Facebook Marketplace. Overall, the number of people who can participate in online commerce will grow by a factor of 5 in 5 years. Most of those people are not going to be looking for high-value items. They'll be looking for buying and selling low-value items in unprecedented numbers. So digital currencies will be turning us into a planet of traders. Everyone with a smartphone will have all that they need to buy and sell in the palm of their hand. The smartphone is going to be their digital payments terminal. It's going to be their marketplace. It's going to be their sales management tool. It's going to be their vendor management tool. It's going to be their customer relationship manager. It's going to be their marketing tool, and on and on and on and on. Every one of those functions that we think of as divisions of a business will be reduced to an app, will be reduced to a part of an app that helps people trade. And as people come to understand that using these apps helps them to earn more money, there will be a tremendous demand for those apps. So the digital currency revolution is not the end. It's the beginning. It's the beginning of a much broader revolution that will transform global commerce. Let me illustrate with an example that's now almost a decade old. Again, it's from Kenya. So Kenya got M-Pesa back in 2007, and it got adopted very rapidly. M-Pesa became the dominant payments medium in Kenya. M-Pesa had only been designed to enable peer-to-peer payments, payments between two individuals. And with the exception of a few very large businesses in Kenya, such as the electric utility, it wasn't meant for payments from individuals to businesses. So there were really no ways for SMEs, like a corner shop, to accept payments using M-Pesa. And so the gap between a population who was using digital payments and SMEs who wanted to accept digital payments, that was quickly filled by a startup known as Kopo Kopo. So Kopo Kopo provided SMEs the services that they needed to accept customer payments via M-Pesa. Simple enough. That was only the beginning, because M-Pesa payments are digital, which means they create a digital transaction record, which means that Kopo Kopo was then able to start to analyze that transaction record. Based on that stream of transactions, Kopo Kopo were able to show businesses their projected cash flow, which helped those businesses to plan. But more than that, Kopo Kopo could look at the transaction flow. They could develop an accurate model for the creditworthiness of that business, and then pre-qualify that business for a line of credit at a Kenyan bank. Prior to Kopo Kopo, Kenyan's SMEs didn't have access to bank credit because the cost of qualifying an SME for that credit line far outweighed any of the profits that that credit line would generate. So the banks just stayed away from it. After Kopo Kopo, it became easy for a Kenyan SME to both accept digital payments and to profit from the stream of transaction data that their businesses generated using those digital payments. It gave them insights and it gave them access to credit to help the business. None of that had been predicted. None of that had even been thought of when M-Pesa first came to market. It was just a way to help people send money to one another. And via Kopo Kopo and its competitors, M-Pesa has very rapidly evolved into an engine for SME growth. That process is what we will now see again and again over the next 5 years as we move globally into a widespread adoption of digital currencies. Digital currencies provide that transaction record. There's an opportunity to provide analytics, insights, business guidance, and advice, credit for growth. All of that comes, if not for free, at 1,000th the price it cost before a migration to digital currencies. And all of that is going to drive an accelerating adoption of digital currencies. They're going to be seen as the indispensable tool for doing business in the 21st century, because doing business without digital currencies is going to seem almost impossibly hard. Too much friction, too many speed bumps. For an SME, it's not going to matter whether they're using Libra or Digital Yuan or something else. If it's a global currency, that is going to be enough to unleash this incredible wave of innovation and growth. Now that's the global view. Let's tighten the focus back onto Australia. We already have a sophisticated digital payments infrastructure. But we need to remember, digital payments are not the same thing as digital currencies. Digital payments have costs and have friction that digital currencies do not. Digital payments don't really enable microtransactions. Digital currencies do. Now, we tend to dismiss microtransactions because the amounts are so small, but there are so many of them. For example, most payments in M-Pesa are small, but there are nearly 50 million Kenyans. Most of them are using M-Pesa most days. And those small values in such large numbers add up to 60% of the money volume in the Kenyan economy. When Australia adopts a digital currency, it will gain the capacity for microtransactions. We will be able to pay cents, even tenths of a cent for something. That's going to create a whole new kind of business model. Today, many kinds of online services are purchased on a subscription basis. You can think of Netflix, but this is true for a wide range of services, including a wide range of B2B services. Service providers love subscriptions because they guarantee revenues. Customers hate subscriptions because they're not elastic. They don't reflect the actual use of the service. And it has been difficult to develop services that could be consumed and paid for incrementally because of the microtransaction barrier. The most obvious example to this is online media. We can pay for a subscription to the AFR. We can't pay a few cents to view a particular article of interest. Nor can the AFR, if it has a really hot story, monetize that story beyond its base of subscribers. We have no mechanism for pay-for-page view, and that's because we lack a payments mechanism. And micropayments unlock that capacity. Now, this doesn't mean that all of our media companies will immediately migrate to pay-per-view. They might be completely satisfied with all of their subscription models. What it does mean is that a host of new competitors will arrive who will embrace the pay-as-you-go model. And that could be an article in the AFR. It could be answering a question. It could be providing advice. It could be conducting a trade. If the 21st century is the century of services, just as the 20th century was the century of products, we are going to need financial instruments that allow us to pay for those services. And that's really why we will be adopting digital currencies here. As we do, we're going to be forced to rethink every business model. Can it be delivered as a service? How can we bill for it? How can we make it easy for customers to consume this service on demand? How can we integrate this service with other services provided by others and build value chains of new services? These are really interesting questions because they're all growth questions. They're all innovation questions. And they're the kinds of questions that we will be asking as we cross the gap between what we can do today with digital payments and what's possible soon with digital currencies. Digital currencies gift us with new capacities, new potentials, new possibilities. Digital currencies provide a foundation for incredible economic growth. All of this is only going to happen if businesses take advantage of it. So ask yourselves, how can you position your business to reap the rewards of digital currencies? Because if you do, you will unleash revolutionary innovation in your own businesses, and you will reap the benefits of growth. Thank you.